Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, September 14th, 2023. It's 11:33 a.m. Eastern Times. I'm starting this video, and I'm just going to go over things to watch. In fact, I have a watch list. I've shared it with you before. I've called my TTW Things to Watch list, and it's just an eclectic mix of various things to watch. I'm not going to go over each and every one, or maybe I can rifle through some of the charts quick at the end if there's time. But I'm going to start out here with just the common theme, which I've been talking about lately. If you're frustrated, if you only trade the equity markets, the indexes, that is, SPY, the S&P 500, ES futures, QQQ, there's a lot of a lot of active trading apps. Ops opportunities. That is, if if you're down on the 5-minute charts, but if you're a swing or trend trader, now you've gone nowhere for 3 months. This is QQQ. SPY looks almost the same. You can see we peaked here back where we're at in June 16th, right there, 3 months ago, and that's exactly where we're at today. So I've covered this. And so again, recognize the kind of market we're in and adjust accordingly. Now, and this is what I'll do in this video, there's plenty of money to be made elsewhere, just not right now in the equity markets, unless you're an active trader. And by that, and I can't post these all the time. If I'm trading the indexes, which I'm place thousands of trades a year, and hundreds, many hundreds in the NASDAQ 100 futures or small caps. But this is really, your go-to time frame here. That's the 5-minute chart. If you're active trading, just look for, support levels, trend line breaks, divergent highs, divergent lows, divergent highs, you drop, divergent highs, you rally, divergent high, you drop, divergent low, you rally, divergent high, you drop. ADL, it's an almost divergent low, it's a rally. There's a little bearish rising wedge. It broke down. There's your, sell signal. That's the bearish rising wedge right there. Here, zoom in. So again, you can do this all day long, and I don't post these because this is not what this site's about. It's about swing trading primarily, trend trading, investing, and things like that. It's just impossible to keep up with an active trader. And there's your divergent low, and that's giving us this rally. And we're coming up. We have what I call an ADH, almost divergent high right here, but we took it out. So it's not quite a divergent high. It's almost, you almost have an equal high on the RSI. RSI's up here in PPO. But sometimes that's what you get. This was an ADL or almost divergent low. And what I will say is it's at resistance right now. You can certainly, as an active trader, take a shot on a short here for a pullback trade at 377.48. Why? Because there was a gap there, a reaction high, the bottom of the gap, another reaction high there. So, and the way it works is, probably pull back. A minimum pullback target would be right here. Again, this is just active trader stuff. If I have to tell you about this, it's not your wheelhouse. Don't do it. Wait for the next opportunity in the market, but I'm going to get to the other things right now. Now, if we punch on through there, then the next stop, you can see next resistance up here about 379.34. And so, overall, we had some decent economic data yesterday, and this is what I'm going to talk about and things to watch. Yesterday, the CPI came in hotter than expected. It came in above consensus. Initially, in the morning, the futures spiked down pretty good right away because the CPI report came in month over month, was above expectations. And then the market kind of wrote it off. And here's a common theme I'm going to cover in this video. We're going to look at three main things, and that is commodities, particularly energy, because that one is reflected right away in the CPI. I talked about that yesterday. You can use any of the various commodity tracking ETFs, the broad-based ones, or individual commodity ETNs like wheat, corn, soybeans, USO for crude, or of course futures. Futures are the pure play. Remember, all those commodity tracking ETNs, like we're trading like wheat and corn and soybeans and whatever else, they only track, and even UNG and USO, they're just tracking the futures. So the futures are what the pros are trading, what those ETNs or ETFs are using to track that particular commodity. So, if you're, comfortable with futures, you have access to futures charts. Investing.com will give you free real-time futures charts. If you don't, most brokers will as well. And so keep an eye on those. But where I was going with that is, as I said yesterday, the things that have a real time and immediate impact on inflation are crude and natural gas. Those things, there's no lag. When you go to the agricultural commodities, food, for example, lean cattle, live hogs, corn, soybean, wheat, all those things that do certainly affect the rate of inflation or deflation, depending if they're going up or down. But there's a significant lag. It can be very substantial because in the CPI they're only using the finished goods, processed foods, foods that you're buying in the the grocery store. And so wheat could spike up in a month 15-20%. Doesn't mean that whoever your bread company is going to raise the price of a loaf of bread, at least right away. But if those trends persist, you look at wheat, and wheat continues to rise like it did here, you are going to see that cost eventually. General Mills or whoever's making your cereal or bread, they're going to have to pass that along to the consumer. So this is kind of what I'm talking about. And so we'll watch. Wheat, like I said, has a very constructive chart. My take is that we're in this was a corrective wave in a new bull market, and I still have these targets. We already hit T1, T2. I think we're going up here, and I think the bull market will resume, and that's that. But that's not going to move the needle very much on the stock market. So this is not, these ag commodities are not in my TTW or things to watch list. What is, because that is immediately reflected in the CPI, this is what we feel the pressure on right away is crude. And a big one too is, let's not forget, gasoline prices. This is UGA. If you want to track gasoline, simple. There are unleaded gasoline futures, but of course you can just use this ETF. It's easy, UGA. And here we are. And this is just showing you that gasoline prices are now challenging, getting close to their multi-year highs back here where they hit. And remember, this is what crippled the market. This is all along here was the Fed in denial, complete and utter bold-faced denial that inflation was real or risk. It was only transitory, blah, 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 until it wasn't. And then they pulled their 180 and then embarked on the most aggressive rate hiking campaign in many decades. So, and now here we are. My point is we're back to that. And, the vast consensus is the Fed is not going to raise at the next meeting. I haven't checked the Fed fund futures. Maybe that's changed, but I doubt it. But watch this, because if it does this not only is more of a real-time effect on inflation numbers, on the CPI and the other measures that the Fed uses. This is real-time and also has one of the biggest components to the consumer price index, and that's energy. That's the cost of oil, natural gas, fuel, and it permeates through all levels of the economy. As I said yesterday, crude oil prices, obviously gasoline and crude prices are going to track in tandem. That's just kind of a given. Sometimes there's a little bit of a variance depending on what's going on at the refiners, but in crude is not just that, it's the gasoline we put in our cars or the heating oil that heats our home. Like I said, it's used in all aspects of manufacturing. Even this, they're trying to kill crude in DC, but yet, to mine lithium and other metals that are coming out of the ground to make, and the production costs to make all these batteries going in the hybrid cars and the solar panels, and then of course energy to run the power plants that charge those cars. It all comes back to this. So make no mistake about it. It's one of the biggest inputs ultimately, whether it's the direct measure or a lag time on like finished products. Watch this. Okay, so I don't want to beat a dead horse here, and I do think there's a correction coming soon. Like I mentioned, this took a starter short on crude, and waiting to see a little more evidence to add to that. And natural gas is showing me the same thing too. Look, probably going to correct soon. You have some divergence forming here, just like you had a divergent high there. There was your sell signal, and you got a correction. But again, the point is, this is already done. This damage to a greater or lesser degree has already been inflicted. It's kind of like the analogy I use, and this might be a little crass, but the graphic to some, but a hunter, sometimes a hunter makes a shot, clean shot. the elk or the deer drops down right away, but quite often, they take a shot and it's not an immediate kill shot. But the damage has been done. They're going to track that elk on the blood trail, and because the bullet went in, and it's probably severed some arteries or organs again. Maybe I'm being a little too graphic, but this is how my mind works. This is the lag time here, and so this damage is being felt right now in the economy. It's not being reflected in the stock market, and that's the whole point of this. Best case scenario for the market would see a significant drop here. But even if we just come back, if you look at all these lines right here, let me color it up. This is a big level right here, I believe, and I'm going to color that up for you right now. Let's make it purple. That shows a little better. About on gasoline prices, UGA 65.5 right there. That was just there was a major reaction high there. We broke above it for a little bit, failed, and then it was resistance, boom, breakout. The way technical analysis works is resistance once broken then becomes support. In looking at the wedge, it's using pure technical analysis on this. You can factor in your own fundamental analysis and kind of guess where gas prices are going. Good luck with that. But technical analysis says this is a rising wedge. There's a well-defined uptrend line. Widest part of the wedge is a measured target. So if the wedge broke down right here, it's just going to take us down. The measured target would be a back test of this level, and followed that, and that would complete the measured move for that pattern. Again, technical analysis doesn't guarantee it's there. This is the bottom of a trading range. If we happen to fall well into the range, the way it works from my experience is once you enter a well-defined trading range from above, a solid entry, the next stop, other than the midpoint of the range, ultimately you're probably going to go back down to the bottom. So this is bullish for the stock market. And I'm kind of giving you just things to watch again, not... it's actionable if you want to, here's actionable breakdown, short gasoline right there, cover right there, game of bounce. There's also first support / target at about 69. So, there's plenty of, when I cover these charts, you can take it as a trade idea as well. I just don't, it's not actionable at this moment. I don't see a sell signal on gasoline. Right now, it's still in an uptrend. And just like I said yesterday in crude, it was completely a counter-trend trade, 110% in an uptrend with no signs of reversal yet. And I'll get to crude in 1 second. But just know that fundamentals do matter. They may not matter right away. And that's why, given the choice of only fundamental analysis or technical analysis, 10 times out of 10, I'm going to choose technical analysis as my guide to figuring out where the market or a stock or a commodity is going. It's much more accurate in predicting that, especially in the very near term. Fundamental analysis works well if you're Warren Buffett and you have a holding period of, 5 to 10 years. But if you're swing trading and trying to game the zigs and zags in the market, you're trying to do this, fundamental analysis is useless. This is the realm of the swing trader here. Recognize you're in a price channel. Swing the top, swing the bottom, buy the breakout. Sell the breakdown, game that bounce off 69, swing it down to 65.52. That's what we do here. Okay, so I'm going all over the place, but just know that, again, this is real, and it was completely dismissed. It was initially recognized yesterday when the CPI came out, and then the market just blew it off, saying, well, overall, okay, you back out food and energy, volatile food and energy, core inflation wasn't that bad. That's what the headline said. Well, guess what? This is real, and it is, again, one of the biggest components. Hits the consumer harder than anything. Most consumers are commuting to work to fuel their car up, or they got to plug in their Prius or whatever full hybrid is into the and pay for the inflated energy costs. I know my electric bill, I looked at it just recently. It's gone up over 100 a month in just the last year. That's from the increases passed along by our local utility provider down here, Florida Power and Light. And so those things add up. And I heard people that plug their car in see a big spike in their energy bill. Those that have those full hybrids like Teslas and whatnot. Okay, enough on that. I probably talked a little bit longer than I should have, but it's because I think it's that important. I've seen many, many times. You can go all the way back to the dot-com bubble where fundamentals and earnings and sound business models didn't matter until they did with the dot-com bubble. And when they did, they finally mattered pretty big. And the thing is, and I'm going to show you a couple more charts here, the longer these disconnects go, let me use another analogy. Again, it may be a little graphic, and my apologies, but let's just say you ignore that pain in your ribs or in rib cage in the back, or your cough for a few months. You keep letting it go, and someone tells you, get that cough checked out and get that pain in your ribs checked out. And it's a tumor forming, and you can ignore it. The longer you ignore it, the more detrimental it's going to be when it finally you realize, hey, I've got stage 4 lung cancer, where it could have been 1 or 2 if you had that persistent cough or pain in your ribs checked out earlier. That's what happens when there's a disconnect in financial markets between things that do matter, have historically mattered, such as increasing energy prices, increasing inflation in a inflationary environment, which is by most accounts been declared the war has been won. The soft landing, the hard landing scenario has been removed by just about every major firm out there, including the Fed. Even the soft landing case has been removed by most, and good times are going to roar. But this is, again, it's that vicious cycle I've been talking about for over a year now, or negative feedback loop, where you're going to see these little abatements of inflation, softer than expected CPI reports, or inflation coming down. The stock market will rally. Interest rates will go down, and then the inverse or the opposite will happen. You'll start to see the next leg up in commodity prices, the next leg up in interest rates, i.e. treasury bonds, which we're going to get to, and then the cycle continues. There's more talk that the Fed's job's not done, higher rates to come, or interest rates going to stay high, and then stock prices will correct. So that's more of a macro thing. It's not timing, but you can time things like this, these levels I just gave you here. All right. Gosh, that's a lot to talk about on just unleaded gas, but I just wanted to bring that up because I didn't, I brought up crude yesterday. So here's crude. Crude did the same thing. Crude also, like natural gas, had a major resistance level right here. It was support. We broke it. Danced through it a little bit, but since most importantly, I always put a higher weighting on more recent technicals. In other words, if this level has been acting as, which it has, about $72, very good resistance all year, all of 2023, even late 2022, that's more important than the $72 level acting as support or resistance back in 2013. Follow me? So, or back here. So most importantly, this has been a big level capping all advances in crude oil, and we recently broke out. And so right now, this say again, TA 101 says resistance once broken becomes support. So while I do expect a pullback, it'll be abatement. It might give us that could very well be the catalyst for that marginal new high scenario that I'm still very much open to, because we haven't triggered those sell signals we need in the equity markets, the next ones to come. And so this could be that new high. I drew the next arrow there, but that would be it. So you come back down, back test the breakout. It would be commensurate with these divergences here. So we could be short, crude oil, long equities at that point in time, and then boom, right when the markets are cheering the fall in energy prices is when they reverse. They back test the support level, buyers step in, and we have, again, persistently high crude prices. You zoom back, crude's up here, and that's where we had persistently high crude prices here, and it didn't matter until it did. And then it took down the market. Obviously, COVID hit in there as well. But just remember, we're at multi-year highs in crude oil, and not far off that multi-year high back there from 2022. So that's it. Just wanted to talk on that, and then the other things. Let us not forget interest rates. Very, very important. And the same thing. This is something else that the markets are, in my opinion, completely dismissive of, and very little margin for error, in my opinion, because we've already seen the tick up in inflation that I just spent a lot of time talking about on energy prices. That's real. It's quantifiable. It's right there. You can't argue that. Nor can you argue the impact that rising crude and gasoline prices have on the economy and inflation. And then you have, of course, interest rates. This is the 10-year yield that I've been harping on, pushing up at multi-year, even decade-plus highs. You have to go all the way back to 2007, right before the financial crisis, right when the last real bear market started around October of 2007, till you had rates this high. And so you had that abatement, and again, I've talked about it repeatedly. It was the farthest thing from mere coincidence that interest rates peaked in October and started falling, and that coincided with the bottom in the stock market in mid-October, right? But what happened since then is, well, interest rates are right back to where they were back then, at the trough of the bear market or correction, whatever you want to call it, that at this point ended in October of 2022. But we're right back there, yet the stock market, is, instead of being down at those lows right here, there's the October lows, that's where you would think it would be based on interest rates. It's completely dismissive, and it's more on the opposite. It's closer to its previous bull market highs. So, if it was tracking the interest rates that really were been assigned to the rate hikes, is in inflation and higher long-term rates, the cause for this drop, then this is where the stock market would be from that perspective, right? It would be right in line with those October 15 lows in the stock market, but it's all the way over here. So one of the two is going to give. Look, the stock market's going to be right, or the bond market's going to be right. We'll see. But those are, again, things to watch. I've said it many times. It can go either way. There's a case to be made, and certainly by technical analysis, if you break this, there's negative divergences in place down on the indicators. So I do think this is ultimately going to go this way. Even if we get a brief breakout to the highs, it'll still be a divergent high, and we'll go down. And and this is really a very complex, thesis I'm working off of, or my preferred scenario. It's going to be this drop in yields, interest rates, is going to be from a combination of two things. It's a flight to safety. I think it'll occur at some point, maybe not right away, but when we're going to see these falling rates, I think it's going to be coinciding with a drop, the next leg down in the stock market, a flight to safety, institutions selling stocks, buying bonds, treasury bonds for safety, and also forecasting future economic weakness, because that's what the bond market does. Interest rates, long-term 10 and 30-year bond rates, will fall when market participants, and remember, it's a smart money generally trading treasury bonds. How many you that I'm talking to, or the Reddit groups, and that quit their job or stayed home with COVID and started day trading and doing that, how many of those trade treasury bonds? No, they're chasing AMC and Bitcoin and all that kind of stuff. So it's the pros that trade treasury bonds. The bond market more often than not is right more often than the stock market. And so that's it also goes back to economics 101. This is just, it's a known thing. If the long term, if the outlook for economic growth is down, in other words, the market's forecasting a recession or slowing growth, long-term rates will typically fall, because investors aren't going to lock in at current rates because they think rates are going to fall. Likewise, if they expect economic growth or inflation to increase, that's what brings long-term rates up. So this is kind of where I think we're going ultimately. And this is macro stuff. It's macro to the point that it happens. So those scenarios that I gave you are macro. So it's not like breakdown right here and okay, the market's going to start melting down. No, if we broke down now, the initial breakdown in the abatement or falling yields would actually probably be bullish for the stock market and give us that marginal new high scenario I've been talking about, because Wall Street would be cheering, equity traders would be cheering the drop in longer term rates, and then ultimately when the market peaks, makes that marginal new high, if that's what it does, and starts to fall, and they see the breakout fail, that's where the rest of the drop would be associated to that future expectations of increased odds of a recession and or institutional money moving into treasury bonds as a flight to safety. Okay, man, if you've just heard for the last 20 minutes, blah, 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 and your head's spinning, okay, maybe this can happen, that can happen. Again, I'm just laying out things to watch going forward, things that are likely to affect the stock market sooner or later. But I'm going to get to, where to make money, and, we'll get you 2 trade ideas. I put out 2 posts earlier today. Obviously, those are the most actionable trade ideas that I see. That's why I usually try to time, if I'm getting something out to you, especially trade ideas. Well, those are the 2 right now I think look good. But this is the Euro USD. I have different boards here. I'm going to put a little trend line right here. We are at support. So ECB today raised. European Central Bank raised rates to a record high. They signal it might be enough to combat inflation, but they didn't rule out further increases, right? Sounds just like the Fed. Now, it is a little bit of a bizarre world. When again, maybe it was because it was fully priced in, but we're actually seeing the euro down against the dollar. Normally, that would go up. What causes any country's currency to go up is really their interest rates. For the most part, there's a whole, stability of the country, the government, and their ability to pay back. But for the most part, it's going to be by interest rates. So the country, one country increases their rates against another, that country's currency should go up. Makes sense, right? Because and vice versa. So instead of the euro rallying today, it dropped. It's still down, which is unusual. And I'm going to get what's unusual. So I'm going to get to gold and silver in a second. But we're also at support right here. Pretty decent support. I have different boards here, but this was bigger picture. This whole drop in the euro was completely telegraphed and very, pretty obvious in my opinion. We, identified it. We had negative divergence there, ran into resistance, but we are now at support, and we're also oversold on the euro. We've been oversold for a little bit here, but we're still down on oversold territory. Last time we were oversold was right there. Time before they were almost oversold right there. We didn't go up right away, but we never went down either. We stayed there and then rallied. So pretty easy stuff, right? It's not rocket science. The euro is likely due for a bounce soon, and probably really soon, I think. And that's why I threw out silver as along today. By the way, for me to be bullish on silver, and I've said this many times, is obviously to be bullish on gold as well. Silver's not going to go very far without its big brother gold going up as well. And to be bullish on gold and silver is to be bullish on the miners. It's usually a given, but I know, and I've said it many times in the past, but if you're new to the site, just keep that in mind. I just like silver because I've always said this. If I get the call on the metals right, I can either tie up, my money in gold or tie it up in silver, whatever amount I want to put in there. If I'm right, silver's 9 times out of 10 is going to go up more than gold in percentage terms, just like GDX will go up more than gold in percentage terms. So why not get paid for it? I'm either going to be right or wrong. So that's why I throw out silver usually. And I just didn't get the gold charts out to you today. But there it is. So, and they are highly correlated with the euro. Here, I'll just show you. Well, no, we'll do it on another board. Let me show you my main board here. That was the divergent high, divergent high 1, correction 1. divergent high 2, correction 2, divergent high 3, correction 3, but this one was a little different because we broke that primary uptrend line. And as I just showed you on that other board, we're at support right there. 60-minute, that pesky little divergence has been building, is still, believe it or not, in place on the 60-minute chart as well, and that shows through on the daily, I believe, but here it's still there on the 60. They haven't yet taken it out. You're making higher or equal lows on the indicators, higher definitely on the PPO, versus lower lows in prices, so you just move the lines. It's like getting a first down in football. You get a first down, they move the markers, and that's what we do until there's no longer divergence. So there's the case to pop. What we're seeing today is also unusual because, as I've showed you many times, you look at the stock market, and what we need to compare it to is FXE. That's what we're looking at here. So let me move this down. Okay, this is the S&P 500 SPY in white, and in purple I use FXE. I'm not using EUR/USD because that trades around the clock and it's not going to match the trades. FXE is the Euro ETF, or ETN, so it trades 9:30 to 4 just like SPY, right? So that's what you want to compare when you put up SPY. And as I've mentioned many times in the past, I'm going to do here again, has been since this bear market. To me, we make a marginal new high, it's still a bear market. Yes, technically, will it be a bear market if the S&P or any one index makes a marginal new high and then goes down? No, but when you look at the big picture and you go out 10, 15 years of 5, 6, 10% marginal new high is basically a double top because that previous high happened in the NASDAQ back in 2021. So if the NASDAQ goes up a few percentage points over that 2021 high and then drops and takes out the lows, when you look at a chart from a bigger perspective, that's just a double top high. Hopefully that makes sense to you. Okay, SPY in white, FXE. This is where the S&P 500 topped also around the end of 2021, early 2022, right there in January. You can see them here. And what I'm showing you here is, well, let's start out what happened before that. Okay. What happened before them was clear divergence. The S&P 500 was going up, the stock market, the U.S. stock market, and the euro was falling. Remember, the euro is just inverse to the dollar. I could have put in UDN here, which is the inverse dollar ETF. It would look exactly the same. You can do the same on your charts. And so what happened is the markets ignored that divergence. And as I said earlier in this video, using that whole lung cancer analogy again, sorry if I know that's probably, anyways, let's just go with that. The longer you ignore something, just like in 2000 or in 2007, leading up to 2006, the housing bubble. I was knee deep in that. I worked for regional banks. I was a financial advisor, stockbroker, but I worked closely with the commercial lending officers, the mortgage loan officers. I was officer of the bank, and we worked closely together. And I saw it. The writing was clearly on the wall. There were people in such denial because prices were going up. They figured they'd always go up. And you could see that whole, liar loan thing happening, truck driver making $50,000-$60,000 a year buying a $400,000 or $500,000 house or second, house to flip. It was rampant. And it didn't matter to those folks till it did. And then when it did, you got the financial crisis, which stemmed from, in large part, the housing bubble. Dot-com bubble in 2000. Fundamentals didn't matter, like I said back then. Didn't matter if you didn't have a proven management team or a business model or earnings. All those things didn't matter until one day they did in March of 2000. That's when that bubble popped, all right? Now, the point is, the bigger the bubble, the bigger the ensuing drop. Let me just jump back to one other chart here, and I'll just show you that. So let's look at the NASDAQ composite. Or you can go to even QQQ. QQQ's the NASDAQ composite's all the stocks in the NASDAQ that trade on the NASDAQ. But and then you can look at QQQ. Let me turn off all the lines. And I just want to measure it for you. The NASDAQ composite, after that bubble popped Many of you listen to my voice probably weren't around then, and if you were, you weren't trading then. It dropped almost 80%, meaning, if you had 100 grand, you were left with, $23,000 in a couple of years if you were buying or just riding that one out, and you didn't get back to where you were until shows what happened. It took you 17 years. So most sold out, capitulated. And if you even want to look at the NASDAQ 100, NDX, QQQ, same thing. It's close, not as much. 83% if I hit it right. Yeah, 83% drop. So even worse. Okay, so it does matter. Fundamentals do matter. The thing is, you can't trade off them. They don't matter, as I like to say. It's my own yogiism, until they do matter, right? Okay, so where am I going with all this? Okay, it didn't matter to the market that the euro was falling, the dollar was rallying against the S&P. The euro was falling, meaning the dollar was rallying again, and the S&P was rallying until it did matter. And then this gave us the biggest drop that we've had in many, many years. And there it is. You can see since then, as has been the case, there has been a very, very tight positive correlation. When I explain these correlations, I've set on the left of the chart, I've set this to show both points. Both the euro, which is FXE in purple, and the S&P 500 in white, to start at the same point here. But remember, currencies move, they're measured in pips. That's out to the fourth decimal. Fourth or fifth decimal. I'm sorry. I'm not a big currency trader because they move so little. The stock market, the currencies don't go up and down 2-3% in a day like the stock market does, or often does. And so you don't look for these lines to be overlapping each other. When you're trying to look at correlations of any two assets, look at the trend. Each one's are they moving up, down? Where are the inflection points? When do they turn? There's an inflection point. They were both moving down, then they had that inflection, a little rally here. They both started going up, then they both went down. Okay, so it's been, as you can see, as I'm rolling the lines, almost a perfect correlation, but every now and then you get a disconnect. And remember, this is the S&P right here. So there was another point after the bear market started right here. I just rolled to it. And you can see where, okay, stock market said, hey guys, let's rally. Yeah, let's rally. But the euro said, no, we're still going down. Stock market ignored it. What happened from there? The S&P dropped. And remember, line charts show you the closing high, not the intraday high. This loss would be bigger. That was the next bear drop into the October lows. It was a 17% as I'm measuring it there on that leg down. Because again, the stock market ignored what had been a very tight correlation. It wanted to rally while the euro was falling, and then boom. And so you can see they resumed. The correlation has resumed. There was a little period there where actually went the other way. Stock market fell, but the euro went up and said, no, stock market, we're not correcting. Now we're rallying. The market said, okay, oh yeah, let's play a game of catch up. So there was, and you can see it. It's pretty tight correlation, right? Except brings us to today. This is why I'm showing you all this. So I roll forward. I can roll back. You can see it. This one you can see pretty good. Here's all of a sudden, this is the first divergence I've seen in a while. This is the S&P 500. It's been moving up for the last few weeks here, where the euro has clearly been falling. So one of two things, and any combination thereof really is likely to happen. What's happened in the past, there's been a mean reversion. That means either you're going to have euro up or the S&P 500 down. That's a reversion to the mean, or all of a sudden this relationship disconnects for a while and doesn't matter anymore. And now the euro and the stock market are going different directions, which means the dollar and the stock market become positively correlated. That's a possibility, but that hasn't been. Until that trend is clear, you have to go with what the very strong correlation. Look at these peaks. these troughs. This is what it's been, and so this tells us that's going to happen. So what's the takeaway here? Okay, this is actionable in my opinion. There's a hedging opportunity. It's what I call an indirect hedge. If you we don't have the next sell signals on the market yet, but if you are short or were to put on short soon, you could go long. Now you can go long the euro. You just have, if you trade it and you put enough in, you make as much money as you want to. When you trade currencies, you trade other things, you're going to leverage up treasury bonds. You put a lot more money because the moves are small. So you have to dollar match the amount. You'll have to do the math yourself and say how much I want in the euro. Or what I'm doing, the reason I gave you silver today, buy gold, silver, the miners. I gave you palladium the other day, and we're going to roll into those. So what happens there is, if we get the reversion, if you were to be, shorting, especially if if you are sector selective right now. Again, I made the case. You're going nowhere shorting or going long the broad markets recently. I've given you more and more individual stock ideas and individual sectors that I like, both on the long and short side. We were short the restaurant and leisure stocks, airlines, things like that, and restaurants, all that played out, home builders, and then also, quite several long individual stocks, mostly lately. And so that is one trade idea there, is to be long either the euro right now against any shorts that you might have. And again, preference being the most bearish sectors or individual stocks versus the broad market at this point in time. Or you can go with gold, silver, and palladium. I gave you palladium. Let's just roll into that and wrap this video up. So the most recent trade ideas, I gave you palladium the other day. It's not on fire, but it's moved off that divergent low. It's up about 6.5% in just the last few days, and I believe I highlighted it before we even broke out here the other day. Big divergences, looks good. And then today I gave you silver. Got that post out to you this morning. That's not silver, that's Schlumberger. My keypad's not working. There it is. There it is. So it's been moving up nice. I think I fired that one off to you right here in the morning, and nice turnaround. So it's up a couple percent. And again, more so this. You gotta love this chart. It either works or it doesn't work out. Again, I don't get married to anything, no matter how good a chart looks. I gave you my, allow for a whipsaw, because that's just what the market does. When all I see a level and it becomes so obvious to most, that's usually when you get those little whipsaws. The market makers or powers that be can take silver down there, blow out all the longs that stepped in here today, and then turn around. When you're selling your shares and the shorts are piling in, then they gun it, and the shorts get squeezed out. So that would be it is my preference, give it a little bit of room, but take it here. That may not happen. I'm not going to sit here and wait for a breakdown that may or may not happen. You buy support, and if you want to hold off and you think that the breakdown's coming, you don't short the breakdown. What you do is, buy it long. You buy a recovery after a breakdown once, if and when 2050 it's recovered again. And I already gave you my targets in that other chart. So there it is. It's, again, watch, rinse, repeat. Divergent low at support, divergent low at support, divergent low at support. There's a divergent low, there's a divergent low. Bam, 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 bam. And, they don't always work out, but this is it. What else did I give you? That Cara, the pot stocks have been running. I highlighted them a couple months back, dropped off my radar, but still, the ACB was the one top pick I gave you, and that one went up and hit that second target or whatever, a couple pennies from it. And then this one took out this morning. So it was plenty of opportunity to get in. It didn't gap up. The entry criteria on that one was a break above, 189, I think it was. 189. So, this morning we opened up, we took out 189 right here. There was your buy point right there. So if you jumped in at 190, that was the entry price. You're up, made already almost 10% today, and it looks good. The point is, now I'm going to end it here because this video has gone long enough. The pot stocks, I've traded the pot stocks for many, many years before, most of them were penny stocks back then. And I trade them long, short, just like Bitcoin, just like the stock market, just like any sector. I have no allegiance to it. I'm not a gold bug. I'm not a perma anything. And I just hit and run, whether the opportunity says go long, go short. But I've learned that this is a hot money sector. When the pot stocks are running, they can run. They can really run. But it's like a game of musical chairs. Get in, get out. Do not stay too late to the party. You do not want to be the bag holder. There's MJ. I gave you that one back then a couple weeks back too. Broke out, back tested, and then exploded off there. I haven't modified. That was the same targets like these were I gave you back then in July 10th. Would have been that video. And there's the next stop if we head up there and power through. So as long as the momentum's there, the volume, you can see huge volume on MJ, a lot of these pot stocks, they should run. Now, where am I going with this? Cara is one of my, I've traded this one for many years. I've had it trade ideas on the site. It is a biotech company, but they deal with a lot of the cannabis-based products. And so it's kind of like trading. You can get in Bitcoin. When you see Bitcoin or Ethereum start to run, ultimately you're going to see what I call the peripheral stocks, the related ones like MARA, MARA, and Overstock, OSTK. Those guys then start to catch a bid. So that's what we're seeing here. So for those of you that missed, ACB or any of the others, boom, this one will usually run up until as long as those pot stocks are running. So watch those. If you see the pot stocks all hitting resistance and then going down, if it looks like the end of the run, then this guy, you may want to pull the plug. So just for now, it's there. It's a breakout. First target, second, third, fourth, fifth. I don't know right now if it's going to get all the way up there at this point in time. Let's just see what happens. If we get to the first target, it's going to be decent gain. I'm just going to measure it here for you. It should be about a 31%, 32% gain if it gets there. So, and again, that's where the opportunities are. So as of today, Cara and the metals and GDX, all the same. If you're, again, to be bullish, gold. There it is. Divergent low we had on GDX, divergent high, pullback. These are still potential targets for GDX if you took it here. Next target zone, and then 33 would be your current final target, but that's subject to change. All right, guys, I'm going to wrap it up here. Long video, get it out to you guys. And like I said, keep an eye on really that divergence between the euro. And like I said, I think it's somewhat of a pretty hedged bet. One way or another, either the euro is going to rally or the stock market's going to come down. That divergence is going to get closed. So like I said, you can consider a paired trade there if you want to kind of hedge up your risk. This has been Randy Finney with Right Side of the Chart. Have a great day.